Good morning, ladies and gentlemen. A quick review of the price action of last week shows us a market which actually is quite obvious that it has not made up its mind as to what it wants to do next just yet. This is a daily chart of the 2-year note in the States, and it's basically been range trading. It got up to nearly the levels we wanted to sell, came back down, and it's now drifting back up. If we look at a chart of the 5-year yield, shows us the same. It retraced 23.6% and then thought it would try the higher yields, but on Friday basically it failed with the Trump inauguration. And I don't know what you thought of it, but I thought it was pretty weird, and the statements over the weekend have been even weirder. And I guess the market is as puzzled as we are as to what the guy is actually going to do. He seems to be saying that he's going to get down to work, but he seems to be far more concerned with the numbers that were present at his inauguration, as opposed to explaining us any policies. How Congress is going to take that and how much they're going to be willing to cooperate with him remains to be seen. And I guess that is what the market is saying. The market was getting ready for a push higher, but thought better of it. So what are we left with? We are left with moving averages which are slowly catching up with the new levels the market is trading at. And if we change that to a weekly, we are left with a market which is still trading above the 1.875% yield that held it all the way since 2013. So that is 4 years worth of price action, which should resolve itself way to the upside. Just probably not yet. The market is bull flagging, which it has the potential to put in a few more flags over the next few weeks before it decides which way it's going to go. What is interesting is that last week the yield curve actually steepened. 2 years performed well, 30 years performed relatively badly. That is a sign of people putting money, parking money in short-term instruments until the dichotomies present in this market resolve themselves. The 10-year note is, again, just like the 5-year note, stuck between the 23.6% retracement of the whole move and the decision to make a new leg higher. We think that the market will make a new leg higher and get above the 2.6% yield, but obviously not yet. It is just as obvious in a chart of, let's say, TLT for the 30-year note that the market is now contained by these moving averages which are turning over the top, but it has huge support around the 117, 118 area, and it is going to be very tough to break those levels without some more consolidation. The European markets are actually more interesting, and they are better seen on the yield charts. The 5-year note, the bobble, the 5-year, has actually broken higher for the first time since the December ECB meeting. This seems to be saying at least to us, that the next move in yields is going to be considerably higher, probably towards this area here, which is minus 22 basis points. It probably needs some more consolidation itself before it attempts those levels. The same is obvious on the 10-year note, the Bund. It is going to be very, very hard to break this into the 40s. It has this level has been very well bought for many, many years, ever since 2015. So we think it's going to be a huge tell if the market now begins to trade in the 50s. We don't expect that yet to happen, because the signs from the hourlies and from the dailies are not as positive. Those can be seen here. This is a daily chart of Bund. This actually is not a gap, it's the change in the contract. The changes in contracts produce these up and downs, which are actually best ignored and looked on the hourly charts. 133.25 is now beginning to be extremely important. We closed decisively below it. We suspect that what we're going to do now is actually have significant tests of the moving average, which is finally turning over, and any move towards between 25 and 45 we shall be sellers of, with a stop above 63. At least that is now our intention. So 25 to 55 is our sell area, with a stop above 65. The Schatz, the 2-year note, is actually even clearer. Any move, I'm sorry, wrong contract. Any move in the Schatz up to 25 to 27 is now a major sell, hoping to retest the levels around 112.05. So we actually have the European curves, which are becoming less steep, while the American curve is becoming steeper. That should have a profound effect on the dollar in the next few days. We would not be surprised to see now a push up towards this 108.27 level, which we think would be a great sell for a move back down towards 103 eventually. So that is what the yield curves are telling us, but the major message is one of indecision, and one in which it is best to look at hourly charts and weekly charts and ignore the daily charts. The trend in European markets should definitely be for higher yields, and the trend in US markets should be for a steepening of the yield curve, as people, because of the indecision and complete unknown that Trump is, actually park money in the short end and just take a wait and see attitude. The wait and see attitude in fixed income is actually reflected in a no attitude and no movement at all in the equity markets. We have now been stuck in a 10 to 15 point range between, let's call it 2253 and 2280 or 82 in the S&Ps for over 2 weeks. We think very soon that has to resolve itself. And we think that it probably resolves itself, excuse me, to the upside. It is very rare for this kind of formation to be a long-term top. We think a long-term top has to be spiky. We shall see how that works, but certainly nothing that we have held as a belief over the past 2 weeks has changed. If the market breaks down and closes below 2240 ES, we think that will probably drag it all the way back down towards this 2175 area, which has been so pivotal. This kind of area, which has been so pivotal for the past several months. The volatility keeps coming off, and that is a something that we really can't understand. The market is record short of volatility and record short of bonds. That is not going to end well. When that happens and what the break will be, well, it will be something that Trump does as opposed to something which Trump sells, as opposed to something which the market has in its head that Trump might do. It actually has to be a fact, something quite visible to the market, which tells it, no, you've been wrong in rallying since Trump's election. What you thought he was going to do, he's not going to do. And that, I guess, is going to take quite some time to reveal itself. Or on the other hand, it might not. It all can change with one Trump action, but I guess we are waiting for that action to actually manifest itself, as opposed to all the talk in the media behind it. The European market, and this is a chart of daily stocks 50, is actually doing exactly what we thought it would do, and that is hold the 3325 area. Numerous pushes up have failed, and the market now is what we think in a precarious position, whereby you think you could see very easily a move back down to 3200 before the next attempt to break 3325 and push higher. We are long-term bullish of this market, yet we see the need for either a closing weekly break above 3325 to get bullish, or this potential mini dump towards the 3150 to 3200 area to be able to buy it for a long-term leg higher towards 3600 and 3700. We think being long here is a very poor risk reward. We would rather buy 3300 than buy it here. It just makes very little sense to us. If it breaks the 3325, it is almost a given that it will trade 3500 at the very least. So it is better to wait and either buy a dip, which could easily happen down to 3150, or buy a break of 3325, a closing break on a weekly level. Unfortunately, as far as the Blue Angels and the fundamentals, absolutely nothing has changed. Still hard up against the 17 times line. We don't know what to say. It's likely to break higher because it just held it for such a long time, but that should be the last wave before it comes back down. As far as the sectors are concerned, consumer discretionary is beginning to look slightly better. The energy is still a complete mess and will take however keen we are to buy energy, this is such a huge warning to us. It's going to take such a long time to readjust that we really, in good faith, cannot buy it. The financials we think are all right. They will have mildly disappointing weeks like last week, but this trend in the Blue Angels is pretty obvious, and we think that dips back down towards the 350 area can be very nicely bought. Healthcare is again on the horns of the Trump dilemma because one tweet could destroy it. Yet on the other hand, if it falls below the 14 times Blue Angel, we will be tempted to buy it for the very long term. Industrials, we see very little upside in. It's not a sector that we can hold for the long term. On the other hand, information technology is. It is probably the most highly priced, overbought, whatever you like to call it, but it is the only one with very much accelerating earnings, and it is the fundamental sector that the US is really good at. It is certainly very much a long-term hold. Any dip down towards these levels, we will be very, very keen buyers. We doubt we will see those dips. That is why we keep on saying that the tech-heavy Nasdaq is the best buy for aggressive longs. Materials, they're beginning to push higher, but we think the potential there is probably not that great. We know that a lot of people are very keen on materials. We would rather see an all-time high break accompanied by a complete dump in bonds to be sure that materials are going to outperform on the upside. We don't see that at the moment. We see complete indecision in the bond market. Therefore, we expect complete indecision and false breaks in the material sector as well. Real estate, not a lot to say. Telecommunications, we still like. They're very volatile, but we do think that they are a long-term buy and could easily trade 20 to 30% higher to new all-time highs around the 200 210 area quite soon. Utilities, well, they are not indicating an immediate breakdown in the bond market, are they? If anything, they are indicating a retest of the 18 times Blue Angel. So that is what makes us quite weary of being extremely short in the bonds. And after that review, actually very little has changed. There are no changes to our levels in 5 and 10-year notes. We think the 118.08 level is going to be extremely important. The market basically this week was trying to break higher in yield, lower in price. We think it actually failed mildly, and therefore we leave the 118.08 price in 5-year notes as extremely important. A close above it proves that the market just cannot sustain these yield levels and that the economy is actually not as strong as people would like to make you think. On the other hand, the close below 117.0813 will start the new wave down. That failed very badly on Friday, and therefore that is all we have to say. Watch these levels, 117.0813 and 118.08, and we shall go with a break of either. Bunds, we are not going to get there for the time being, but the bubble is beginning to look very vulnerable. And we are now going to input this sellers at 133.25.45, stop above 65. Again, there is nothing we have to say here that's new and that we need to explain. We think ES will go up least. We think NQ will go up most. Those levels still are valid. The Russell 2000 is the one that's actually looking quite weak at the moment, but it has not closed below 1,346. Which probably is a tell that the next move in all these markets is up. It has flirted with it, it's got people stopped, it's done all sorts of things, but it has not closed below it. Therefore, we can't really see much to change here. European equities, again, don't buy them here, buy them either higher or 3-4% lower. The risk reward here is all wrong. We still tend to believe that volatility in the US dollar is a buy, because we think it has to move with the changes in interest rates. If we are correct, and now we have this change between the EU, i.e. the bunds, and the 10-year notes in the States, this narrowing of the spread, the euro could well spike by at least a couple of percent. We shall see what happens. We're quite happy to hold our own positions and be proven wrong. Anyway, those are the levels again for next week and the explanations of why we think so. Let's hope that next week actually brings us some more clarity, but again, we think that clarity will be brought by Trump actions as opposed to just tweets or anything else that is just for public consumption. We need to see either a Congress which goes with him on all sorts of things like tax cuts or building the wall, or whatever it happens to be, and that will actually tell us that the trend is higher in yields, because what he is promising is actually delivering. If we see now that Congress backstabs from him, then we know that we are actually in a period of how shall I put it, of basically civil war within the Republican Party, and that will not be good for the dollar, it will not be good for yields, and will not be good for equities. Still on the horns of the Trump dilemma, awaiting some actions, and that is all that we can do. Keep the position small until there is far more clarity than there is at the moment. Thank you very much indeed, and see you on Monday.